You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. Most investors believe they hold assets because the assets are worth holding. In fact, the act of holding an asset changes how much they think it's worth. This isn't intuition, it's a measurable phenomenon that shows up in controlled experiments, in portfolio data, and in your own account statements. There's a name for it, the endowment effect, and it explains why you feel like your stocks are worth more than they actually are. The endowment effect emerges from a simple fact. People demand more to give up an asset they own than they would pay to acquire that same asset. That gap between what you'd ask for and what you'd pay reveals something important about how ownership changes our perception of value. Start with a simple observation. Investors hold concentrated positions far longer than diversification theory recommends. They hold individual stocks they've owned for years, even when identical stocks in different sectors might offer better risk-adjusted returns. They resist selling winners to lock in gains. They resist selling losers to stop the bleeding. This holding pattern has measurable consequences. Portfolios remain concentrated, rebalancing is delayed, risk exposure drifts. Traditional finance assumes rational agents rebalance continuously. In reality, ownership creates friction. The asset feels different once you own it. Understanding this gap between how we value owned versus unowned assets is essential for anyone trying to optimize a portfolio. The endowment effect was first named by Richard Thaler in 1980 in his paper Toward a Positive Theory of Consumer Choice. Thaler observed a systematic gap between what people demanded to give up a good they possessed and what they would pay to acquire it. This wasn't a small discrepancy. The gap was persistent and large, even for goods with clear market prices. The question Thaler posed remains central. Why do people value a possession more highly simply because they own it? In 1990, Kahneman, Netsch, and Thaler ran controlled experiments to test whether this gap held under rigorous conditions. They gave some participants a mug, then they offered participants the choice, keep the mug or trade it for a candy bar. The results were striking. Participants who owned the mug demanded significantly more to part with it than non-owners would pay to acquire it. This gap persisted even in market settings where participants could learn the true value through repeated exchange. The endowment effect operates through a mechanism called loss aversion, the tendency to feel the pain of loss more acutely than the joy of equivalent gain. Once you own an asset, selling it feels like a loss. The reference point shifts. The asset is no longer something to acquire, but something to lose. This shift in reference point is automatic. It's not a conscious calculation. Ownership literally changes your brain's valuation framework. There's also a sunk cost element. You've already invested time and money to acquire the asset. That investment creates attachment. The asset becomes part of your portfolio identity. Selling it feels like admitting the original decision was wrong. Financial assets compound this effect. Stocks come with narratives. My tech bet, my dividend play, my growth position. These narratives attach emotion and identity to the asset in ways that raw market data cannot. The causal chain works like this. Ownership creates a reference point. The reference point triggers loss aversion. Loss aversion inflates perceived value. This mechanism explains holding patterns that would otherwise seem irrational, clinging to concentrated positions, refusing to rebalance, resisting diversification. One key insight: the endowment effect is not about the asset's actual quality, it's about the status of ownership itself. An identical stock in your account feels more valuable than the same stock in someone else's account, or in a market index you don't own. This is why portfolio constraints matter. If you own a concentrated position, endowment effects keep it concentrated longer. And the longer you hold it, the stronger the effect becomes. Time plus ownership plus attachment equals stronger perceived value. Financial advisors encounter this constantly. A client holds a concentrated legacy position in a family stock, dividend aristocrat, or old employer shares. Rational rebalancing would say, reduce it. The market doesn't care about ownership history. But ownership history creates the endowment effect. The endowment effect is documented, but it's not universal across all assets and all contexts. It's strongest for assets with emotional or narrative weight. It's weaker for commodities, index funds, and assets treated purely as fungible financial instruments. There's a rational explanation for some holding patterns. Transaction costs, tax efficiency, and volatility tolerance can all justify concentration. An investor might hold a concentrated position not because of endowment effects, but because the transaction cost exceeds the diversification benefit. Professional traders show reduced endowment effects. They treat assets as instruments to trade, not possessions to hold. Their reference point is the market price, not ownership history. They rebalance continuously because the narrative doesn't attach. But for most retail investors, the endowment effect is real. It operates quietly, making slight holdings feel special, making diversification feel like loss. Here's the resolution. The endowment effect explains why you overvalue your holdings, but knowing this is the first step toward engineering around it. The effect operates at the level of perception and attachment. It's not a market force, it's a psychological one. Once you identify it, you can separate emotional valuation from fundamental valuation. Your stock's value to the portfolio is independent of your emotional attachment. This separation is the key move. Ask, does this asset belong in my portfolio based on fundamentals, risk profile, and diversification needs? If the answer is no, the endowment effect has already inflated its value in your mind. That inflation is real. It will influence your decision. The ownership paradox resolves when you reframe the question. You're not losing an asset, you're optimizing a portfolio. Thaler's research showed that merely framing the choice differently reduces the endowment effect. Would you choose to own this today if you didn't already is more powerful than should you sell this. The first question bypasses ownership attachment. It forces a clean evaluation of value based on current conditions, not historical ownership. The data is clear. Investors who regularly rebalance outperform those who don't. The outperformance is modest, but it's consistent, and it comes from systematically defeating the endowment effect. Now, the implication: run a portfolio audit. Identify which holdings you're attached to emotionally. Look for concentrated positions, legacy holdings, stocks with narratives you've told yourself, or assets that feel special. For each one, separate the emotional attachment from the portfolio case. Write down why it belongs in your portfolio, independent of ownership history. If you can't write a compelling forward-looking case based on risk, return, diversification, or fit, that's a signal the endowment effect is at work. The next move: set rebalancing rules that treat all assets as fungible. This is choice architecture working in your favor. Automate rebalancing annually or quarterly. Don't decide in the moment. The decision architecture removes the moment when endowment effects bite hardest. Finally, remember that ownership changes perception. That's not a bug, it's a feature of how human brains work. The intervention isn't to fight it, it's to design around it. Use rules, not feelings. Use frameworks, not narratives. Use rebalancing schedules, not judgment calls in the moment when ownership biases are strongest. Don't fight your brain, engineer your environment. See you next time.